Let's connect then with Mahesh Patil, who joins in our studio, co-CIO, Aditya Birla Sun Life AMC. And thank you so much for taking time out and joining in. Mahesh, at a time at which we're looking at the fears of the virus only deepening, there are projections that the overall world economy is now in a perilous state. How worried should one be?
Yeah, so I think as the virus outbreak spread outside of China into US and other European countries, clearly I think initially it was about China growth slowing down, but if that spreads and there's a pandemic, then clearly you will see global growth outlook start to contract in this quarter. And I mean, at the beginning of the calendar year, there was an expectation that you will see a recovery in global growth. There was a huge amount of liquidity which was being pumped globally. And that was leading to outlook on global growth improving. And I think with the outbreak of the coronavirus, clearly I think that would take a kind of a setback. And there is a risk of trade which is going on. You've seen the US bond yields have touched a new low of 1.3%. Gold has gone off. So I think the money, huge liquidity which came into the markets and the ETFs, if that money starts to pull out, I think you could see some reaction in the market in the near term.
Mahesh, the very basic setup is that there is enough and more liquidity in the world. Liquidity was getting split between India, China, other emerging markets. It may not move to China. It is coming to India because we are net recipients of FI flows post the outbreak of coronavirus. So I'll be looking at 1 or 2 days of correction, maybe a lean patch for a couple of weeks. But ultimately, because there is more liquidity and because bond yields are coming down, the same group of stocks which have outperformed in 18, 19 and made life miserable for fund managers, those stocks will continue to outperform.
Yeah, so I think what we see it as this kind of situation currently, what's panned out, it's a temporary situation, right? So as
the liquidity situation or the coronavirus situation?
Coronavirus situation. In terms of the impact on growth, I think it's a short term. That should not change the long-term outlook on the stocks or the companies which we are looking at. And liquidity will only increase because as concerns about growth slow down, you will see all the central banks coming in and pumping in more liquidity. So already US is talking about two rate cuts in this calendar year. And that's where the bond yields have come down. China has already talked about rate cuts and further stimulus. So when things stabilize, it might take another week or a month or so for us to see, because something which is difficult to predict how it pans out. But as the dust settles down, I think that liquidity, and again, there will be a lot of inventory buildup which will happen in the system. So that could lead to, again, a V-shaped recovery. So I think market correction because of the near-term threat of the virus, I think it's a good opportunity for somebody to look into the market at this point in time. And there has been actually, at the beginning of the year, we've seen the market breadth started to improve. So what we saw in the last 2 years, where the market, the whole liquidity went into only a few stocks, growth stocks or quality stocks, that was beginning to change. And the breadth was improving. In fact, until a few days back, almost 50% of the BSE 500 companies have shown a positive return. So that was a welcoming change. But I think with the near-term concerns, I think it might again be a flight to safety, flight to quality, which would mean that the same stocks could probably do well. But I think as things settle down, I think you will see the wider participation in the market start to play out, because the divergence has been fairly large over the last 2 years or so.
You're starting to look positive on materials, industrials. You know, I'm noticing just names like L&T, NTPC in your recent buys. You know, given that we're seeing this kind of fall, and it could be, brief and more news-driven, but do you really see that revival coming in? Is this a more long-term strategic investment that you're looking at?
So, yeah, I think the domestic growth recovery, which we think things have bottomed out. Last quarter, we saw the growth hitting a new low. But the recovery will be very slow and gradual. So we're not looking at a very sharp recovery from here on. There are some early indicators which are showing things are improving. And domestic situation also in terms of liquidity, in terms of the bank liquidity, things are looking better. Bond yields which had gone up, okay, the spreads which have widened for a lot of these AA and below, that is also starting to come off. So as that liquidity starts to pump in, I think we expect the domestic economy to recover slowly and gradually. And that's why we are betting on some of the names which have been beaten down in the last 2 years or so. And valuations there are more reasonable. So I think this year, or probably if you take a 2-year view, I think domestic growth recovery is a story which we are playing out. And within that consumption, say discretionary consumption, and slightly more later, it will be the infrastructure and the capital goods sector which would pan out. But again, it's a slow build-up. It will take time. We don't see a big, sharp recovery in the domestic economy in the near term.
Sorry. Mahesh, two things have happened. One, crude has got crushed. Bond yields have all almost back to demo levels. 6.1%. We're almost at 6% now. How will this change the way how you would be investing for rest of the year? At the beginning of the year, no one thought crude will come down by 25% or bond yields will come back to 6%. How will this change the way how you value stocks and invest and how earnings will move?
So in interest rates coming down, I think the challenge has been the transmission of interest rates, right? We haven't seen that actually play out. But I think as the risk perception in the market is coming down and liquidity is getting pumped in, banks are sitting on a huge amount of liquidity, and now with the RBI allowing the LTRO window to borrow at 5.1%, I think that will enable banks to actually take more risk and lend. And we're seeing rates come down. So a lot of the mid-tier corporates, okay, which were borrowing at much higher rates, so those rates are coming down. So that should help. Crude oil coming down, it gives some cushion for the government. Okay, on the fiscal side, we see the situation has been very tight and little room for the government to invest and stimulate growth. So if crude oil comes down, I think that will provide some room for the government to provide stimulus and give a push to the economy. So in this context, I would say that clearly the domestic cyclicals will slowly start to do better. Okay, once things steady out over here. Even the banking and financials, some of the NBFCs also, we've seen the second-tier NBFCs which are now starting to get funding. In fact, their borrowing cost has come off around 150 basis points in the last couple of months. And so that could another be a trade which as the credit growth resumes and as interest borrowing cost comes down, you should see these companies again start to see improvement in their margins and ROEs going forward. So I think some of the select financials and select domestic plays is what one can play out in this.
Aditya, China is in the green. I just want to mark it. We'll get it flashed on the ticker as well. As we speak, the Chinese stock markets, the Shanghai Composite, which is the index which matters, is trading at the highest point of the day. It started a bit flat because of Dow, and now gradually and slowly, Chinese stock markets have also stabilized. In this year, however, again, this is largely because of coronavirus. In this year, Chinese stock markets, of course, have taken a dent. They're down, not like in a very alarmistic kind of a manner. But China is trading with the positive bias. Let's get this out also on the ticker, because for me, this is a clear indication of which way global financial markets are moving. What is this?
So it's coronavirus,
China, right? Yeah.
So I think beyond, again, it's very too early to say, right? Because at the time in China, for example, things seem to have peaked out. Again, as the workers, they come back from the holidays and start to go into the factories, one has to see if there is a second round of outbreak which happens. So for the time being, I think China, in terms of the number of cases and this thing, seems to have peaked out. And the fear, and the market reacted the first over there, right? So we're seeing some kind of a stability over there, but I think we have to watch out, right? I mean, one can't say with confidence that things are now looking to have bottomed out. I think the next few weeks will be crucial in terms of how it pans out. But as I said, liquidity, as you know, can do wonders, right? And we've seen that in the last 2 years. I mean, the huge amount of liquidity which has, despite the fundamentals not improving, markets have gone to a different level altogether. So I think that will provide a cushion to the market at the lower levels where I think, and that's what we're seeing. I think things could stabilize in the next few weeks or so.
How are you convincing yourself when you see stocks like DMart and other so-called consumer-dominated big companies when they start moving higher? As a fund manager, ultimately you want to take your NAVs higher. But when stocks which fundamentally have gone beyond a logical stretch of imagination, when they start rising and rising and rising and rising, how do you keep your discipline? Or are you also tempted to look at them?
So I think one is that the market
For record, you don't own DMart, right?
We don't own much. Okay. We don't own much. We have a very small holding there. So that's a big dilemma. I mean, see, liquidity and market forces can drive market valuations to irrational levels in the short to medium terms, and it can continue. I think for a fund manager, it's important for us to look at I mean, not from the short-term perspective, but slightly from a medium to long-term perspective. And I think eventually growth, okay, and the valuation, I think that framework has to converge, right? I mean, we like growth stocks, okay, we like some of these good high-quality names, but at a price. One has to factor in the fact that there has been good amount of liquidity, interest rates have come down. So to that extent, what criteria are you using for valuing some of these companies? Okay, that needs to be relooked into. To that extent, one can have some kind of leeway over there, but beyond a point when something becomes irrational, I think one has to just stay back from that and keep on searching for new opportunities. There are always stocks, okay, which are still not being caught that fancy, right? And they could catch the fancy later. I mean, there are enough good quality companies which are generating enough decent ROEs, and focus on those ideas, and then hope the market catches the fancy and then catch up with some of these names which have already run up. I mean, that's the continuous process we have to do, and for us to keep in pace in terms of beating the benchmark.
We're watching out for this big IPO, SBI Cards.
Yeah.
Let's talk about that. Let's talk about SBI first. Is it on your radar? I noticed some selling in SBI, and then also the big IPO that's later next week.
So I think, I mean, we don't talk about individual stocks, but I think companies which are, especially in the banking sector, which are being able to, one is the core banking itself, but there's a lot of value creation which has happened in terms of subsidiaries, okay, which are there, whether it's the asset management company, the insurance company, or the cards company in this case. That is unlocking value, and that value creation, and it's to some extent dependent on the bank distribution strength and distribution reach, okay, which is driving value in some of these underlying subsidiaries. And I think that unlocking as it happens, I think that creates a new benchmark, okay, for us to look at some of these names. And in many companies, we have seen that the value of the underlying business which they have floated is much larger than the actual company. So I think one has to look at from that perspective what value creation companies can do, and then accordingly build that into your model and SOTP when one is looking at some of these names. And especially when some companies come which are like SBI Cards, for example, which is a unique name in that particular sector. There's a lot of fancy which is there because people always want to chase a new sector, and there's not much alternatives to invest in that space. And especially with the companies growing, I mean, market is willing to play a premium for growth in this environment, and companies which are demonstrating growth of around 20-25% or more, there is always a rush and a huge premium which is being paid in the market at this point in time.
What are the markets telling you in case of SBI IPO? I think markets are telling you that if it's just because you're a PSU does not mean you should get a stepmotherly treatment. The case in point here is some of those railway subsidiaries which have gone public, and what has happened to good old IRTC.
Right.
These are classic examples that good PSU business also is getting rewarded. The problem with PSUs is that good businesses have become bad businesses, good assets have become bad assets, and good natural resource companies, they've just been punished with high dividend and with everything in terms of government bureaucracy. Okay, I think
it's a question about, I think within the PSUs we've seen, I mean, where there is again about growth, right? A lot of PSUs, they're good value stocks, they're good dividend stock, good cash flow, but growth is missing over there, right? Companies which are done in the PSU space where growth is slightly better than the broader market, I think market is willing to look at and pay a premium for that. So it's again a difference between growth and value which is playing
But just
out.
to get a very simple, maths out, I'm sure you must have thought through it, but
Yeah.
I'm just curious to understand that it's not reflected in your portfolio. PSUs have given the highest corporate tax. PSUs have the strongest dividend yield. Corporate tax has come down, and dividend yield or dividend now will be taxed at the hand of the receiver. In both the cases, for a fund, you have an advantage.
Yeah.
Tax earnings go higher, dividend payout is going to increase in the hand of a fund. If the underlying thesis is correct, if my understanding is correct, why is that markets are still not buying PSUs?
So actually, you're right. In fact, we have actually added PSUs in the recent fall because they've become very attractive. The challenge in PSUs has been that the supply of paper, right, which has been coming in. And that's the main reason why markets, because at whatever price you have bought these stocks, I mean, there's a supply coming at a lower level, and that has kept away investors away. But I think things will catch up, as you rightly said. I mean, when you get dividend yields, which is higher than the bond yield in certain cases, and there is some amount of growth also, which is there, clearly you won't lose too much from here. So I think it's a good time to look at some of these stocks when they are beaten down. And again, they might not be high growth, but for investors looking at downside protection and reasonable returns, I think they offer a good value. And I think if government acts sensibly in terms of how they're doing the disinvestment, and there could be potential for some re-rating also in some of these PSU.
So if I put a flash out which says that Mahesh Patil is bullish on PSUs, I will not be incorrect.
Yeah, it would not be.
If I say Mahesh Patil is buying PSU stocks and he plans to buy more PSU stocks, I will not be incorrect.
Yeah, I could say that. But again, we'll have to balance it out, right? But if you ask me whether we are... Yeah, I think there is great value. In fact, we have launched a PSU fund, right? We launched a PSU fund around 2 months back. So they might not be good long-term secular growth, but clearly looking at the risk reward for a reasonable return, I think they offer a reasonable upside.
And if I put a flash out that ET now is Mahesh's favorite business channel, I will be right.
Yeah, of course.
Going then.
Yep.
All right, really appreciate your time.
Thanks.
Thank you for joining us. The last ticker was an important one for us, I guess.